The stock market has behaved wildly in the last few weeks as the Fed tightening and trade issues still plague the markets. In the previous quarter, funds have been selling off particular stocks, and it's quite interesting to see what companies want to get rid of at this time, recalibrating the portfolios and perhaps preparing for more downside. It looks like 2019 is going to be very interesting. You came here for the truth, so let me unveil that for you. Today we are going to look at what's happening in the stock market. I want to give you some details on the technical analysis on the particular indicators that I've been looking at. But first, I wanted to show you the stock that got dumped. Can you guess what that is? Well, let's see. Here's what funds piled into or exited last quarter, and I'll just give it away right at the beginning. Facebook was among the losers as investors scoured their 13F filings of top fund managers to glean trading ideas and parse out trends from the third quarter. Banks were among the winners after a big bet from Warren Buffett. So Facebook was the stock that many of these funds decided to sell off in the third quarter. I did an entire video about Berkshire Hathaway and Warren Buffett. If you haven't seen it, please check that. I go through what he's bought and sold. You can see other details in this article here. Buffett's Berkshire Hathaway ramped up its bet on banks with stakes in JP Morgan and PNC, boosting a position in Bank of America by 29%, Goldman Sachs by 38%. It sold out of Walmart in the quarter. They get into some other details here, but if you really wanted to check it out, just scroll through the list here. I'm not going to go through it all. You'll fall asleep, but you can basically see the top new buys, top exits, boost their stakes, and cut their stakes. You get all those details there, but it doesn't give you the full picture, of course, because you don't know what they had before, and you don't know how many shares they have and how many they added to and so on. This doesn't give you the details, but if you want to, I've covered it many times before, you can see all of that information if something piques your interest. So I'll scroll through just really quickly just to give you an idea of some of these other companies like Berkshire Hathaway. You can see JPM is in there in their top buys and boosted their stakes in Apple. Okay, that's what I had already covered. And you can see Bridgewater at the bottom of the screen here. Obviously, a company that many people are looking at. One of their new buys was GE. Very interesting. We'll see how that turns out. There are many other companies in this list, but as I said, not going to go through it all. I will have the link in the description under the sources if you want to see it for yourself. I have a lot of details to get into today and not a lot of time. You can see Facebook stock right here showing us that all of these different companies own it, and they own a large percentage. I mean, Vanguard and BlackRock alone, over $50 billion worth of this stock. So it is quite a significant amount for two companies. So you can scroll through, see if you're interested. This happens to be holdingschannel.com. All right, so check that out if you want to get into the details of that particular stock. Now I'm going to move into other issues. The 5 US tech companies with the largest cash piles took advantage of the tax reforms to spend more than $115 billion in the first 3 quarters buying back their own stock. Share buybacks. $115 billion share buybacks. The share buybacks so far this year by Apple, Alphabet, Cisco, Microsoft, and Oracle after the tax change came into force are nearly double what the companies spent in the whole of last year, making investors some of the biggest beneficiaries of a plan that was billed as a boost to U.S. jobs. Clearly, we know where their money has been put. There's a lot of talk that this money would be used to create jobs. Unfortunately, that's not the case. Okay, it didn't happen that way. Perhaps some, okay, but all this did was basically prevent the crisis from happening sooner. That's the way it's been working here. I wanted to give you an idea of that. Now, one of those big tech companies, Amazon, Jeff Bezos to employees, one day Amazon will fail, but our job is to delay it as long as possible. In fact, the quote goes on and said that one day Amazon will go bankrupt. That's a quote from Jeff Bezos. An interesting thing that he would say. Normally you don't hear this, particularly in these times, and from an individual like this. So it's interesting to to hear him say that. And he basically just goes on to say that, look, companies these days, they go on for maybe 30 plus years. There are not too many that have been around for 100 plus years. So we don't expect to go on forever. He talks about regulation in here and so on. Company leaders across industries are telling Jim Bear Stearns Kramer off the record that they're worried about a slowdown in the U.S. economy. Let's read the quote. So many CEOs have told me about how quickly things have cooled. So many of them are baffled that we could find ourselves in this late cycle dilemma that wasn't supposed to occur so soon. Isn't that interesting? That CEOs, multiple CEOs that I'm sure he has connections with, are saying the economy is slowing down, the companies are slowing down. They're in a late cycle. I talk about it, I get ridiculed. Jim Cramer talks about it. The guy is somebody that traders are constantly watching. And I know this because I've seen it with my own eyes. Constantly watching, taking the advice. He says it, totally fine. I say it, ridicule. Okay, no worries. I'm used to it. NBER, recession dating versus market realization. Whenever they tell us that there's a recession, just take the last two examples. You can see these green dots right here. And look at the time period in which it takes to get to their actual official suggestion that, oh, by the way, that's when the recession happened. You can see it in these cases. It's basically either in the middle or towards the end. What's the point? Oh, by the way, you remember last year? Yeah, that's the beginning of the recession. They don't want to freak anybody out. That's the whole point of this. And you could just see it on the bottom right-hand corner, basically, economic peak. It shows you, for example, 2007. And this is, I think it's incredible. December 2007. That's where it peaked. The recession officially declared December 2008. 1 year later. Monthly lag, 12 months. And that, by the way, is over a 50% decline. 50% decline. They're always going to be behind. Don't ever rely on them. This is just a chart form showing us that recognition lag 12 months later. I mean, come on. And people take their word for everything they say. Wells Fargo laying off 400 Des Moines workers as it cuts 1,000 jobs across the U.S. Don't worry, everything is fine. Nothing to see here, folks. Move along. That's what they tell us, and yet every single time it's the same thing. They're not going to tell you while it's happening. It's going to be a year after before they admit it. This happens to be Wells Fargo, but other banks have been laying off. Those that are dealing with mortgages and things because of the slowdown in real estate, they're feeling it, they're getting cut. Things are changing with a lot of these robo-advisors. They're having the traders replaced by algorithms. You're not going to have the same amount of jobs that you did after the next recession. They're going to find a way to increase productivity, that's their favorite word, for firing people, replacing them with robots and automation. Now, what's happening here is something that I cover on, if I could, every single video. G4 central banks balance sheets and global equities. These are obviously correlated entirely. I warned about this for countless months now, saying this is going to happen throughout 2018. We have to keep our eyes on it. The market has been fluctuating. I've been ridiculed again. It's okay. I'm not worried, I assure you. Look at the black line. MSCI All Country World Index. Isn't it so funny that the market peaked coinciding entirely with the central bank balance sheets? Could it be a coincidence? Yeah, it's just a coincidence. Don't worry. And then the market came down along with central bank balance sheets. Could it be? I mean, is it possible that what the central banks do are more important than sales estimates and earnings and other stupid garbage that we see in the news? Is that a possibility? That all that garbage is short-term noise and that the central banks have a flipping of the switch that they can simply shut the economy off at any moment? Well, I guess I'm just crazy. S&P 500 versus the MSCI All Country World Index, excluding the US. This right here. Very clear what's happening. The blue line is excluding the US. The red line is the S&P 500. And yes, it has moved up and down, but there is a downtrend from the peak that was experienced, and it's not looking good. A lot of these stocks are at 52-week lows right now in the US markets. How in the world can they claim that everything is just fine? I've seen this time and time again where the stock market appears that it's just fine because there are bright spots. Look at how many stocks are better now than they were, let's say, at the beginning of January. Absolutely, tons of stocks if you want. Average person could fill a portfolio with 4, 5, 10 stocks that have been up and down, but certainly better off than they were at the beginning of the year. But when you look at these funds, major funds, when you look at an actual well-diversified portfolio, it starts to not look so good. But on the way down, things get very, very messy for those who don't diversify. That's the trouble that people find themselves in. It's a very difficult game to play right through cycles. A lot of people are just fine. If this is their first cycle, they haven't been through one before, they're going to seem very smart. But if you want to play through the cycles, you need to actually know what you're doing. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting the channel. And in fact, when you give me a thumbs down, you're actually also supporting the channel. So thanks to all the haters for that. And last but not least, if you want the financial education you were not taught in schools, these two books have got it all. Check them out. Links are in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.